They've been the main source of global growth for years, but we may have to reassess the idea that emerging economies are growth engines without fail. In this business interview, we are looking at the risks that face the global economy and markets in 2013. My guest from New York is Ian Bremmer, president of the consultancy firm Eurasia Group. It's just come out with its list of top 10 risks this year, and emerging markets, surprisingly perhaps, is first on that list. Ian, thanks very much indeed, first of all, for speaking to us. Now, emerging markets have been booming in recent years, but you say that we could be burnt nonetheless this year. Why is that?
Well, for the last 4 years, really the risk environment has been dominated by developed states. It's concerns about the financial sector breaking down in the U.S., a double-dip recession perhaps, the Eurozone imploding, Japan being washed into the sea. All of those risks have actually been overplayed, every single one of them. If I see another Economist cover that shows the euro bursting into flames, I'm going to hurt somebody. But in 2013, emerging markets are much riskier places. There's much more volatility. It's not that they won't grow, they will. But the downside is underappreciated in the same way the downside has been overappreciated by the markets over the last 4 years in the developed world.
So you're basically saying that we need to make a difference between emerging markets and emerging markets. What countries then are in your good books and what countries are in your bad books?
That's right. There are some countries that are emerging that are indeed moving towards becoming developed, and the risks around them are becoming more regularized. You are getting paid well for taking that risk. Brazil is certainly one. Turkey is another. I think that there are a number of states in Asia as well, South Korea, for example, Mexico, all places that are becoming, I think, increasingly developed, may not deserve to be called emerging markets for much longer. But there are many other countries that are either emerging and problematically so, or aren't emerging. They're actually backsliding, they're submerging, that are much more problematic, and the risk is much higher. India, certainly one of those. Many of the countries in the Middle East, places like Egypt, Iraq, even Indonesia is becoming, hitting a lot of headwinds. And Russia doesn't deserve to be a brick. I mean, Russia's not emerging. And a quick point on this, if you remember towards the end of 2012, everyone was asking, these corporations are keeping trillions of dollars on the sidelines until the U.S. election because they're so concerned about instability in the U.S., the unknown. When have you ever heard that corporate CEOs were keeping money on the sidelines because they were so concerned about uncertainty in China? And yet the uncertainty in China, the volatility in China is radically greater than it is in the U.S., in Japan, or in the EU. And given that 2/3 of the world's growth in 2013 is coming out of emerging markets, we really have to pay a lot more attention to that.
Now, China, you just spoke about that country there. It's also in second place when it comes to your top 10 risks. You've labeled this risk as China versus information. Talk us through what you mean by that.
Well, I do believe that China is going to grow quite strongly in 2013. The risk is not to whether or not they can keep the numbers looking good. But the Chinese economy, we used to talk about how the average Chinese felt about China. 10 years ago, you could do that. You can't anymore. It's really two countries. You have middle classes in the urban areas and doing quite well who aren't as concerned about growth, but they want accountability from their government. They live in an information age. Their jobs involve sitting in front of computers, and they expect information in their day-to-day lives. That's not true for folks living in the rural areas or the urban poor, who simply want continued growth the way they've had it for the last 35 years. The Chinese government is not prepared to respond flexibly to those demands. And as the Chinese middle classes on Twitter, on Weibo, the Chinese version of Twitter, are saying, well, why is it that Wen Jiabao's family makes $2.7 billion? Why is it we have this Bo Xilai scandal? The reaction from the Chinese government will be both inflexibility and nationalism. And that's really the danger we're going to see in 2013.
You say, though, that the growth numbers in China will be maintained. But how do you think this risk could manifest itself and when?
Well, I think that the risk is not about hurting growth numbers. The risk is about who benefits from those growth numbers. It's going to be about Japanese companies that increasingly we will see that their Chinese exposures are incredibly dangerous. It'll be about Southeast Asian countries that are more worried about their ability to coexist peacefully about China. It'll be about a U.S.-China and a Canadian-China trade relationship that'll become more fractious and fraught. For the last 20 years, we've looked at China and seen China rising as an unmitigatedly good thing. Thank God for the global economy that China is rising. It's helping everybody else. In 2013, we're going to see the inflection point where China rising will be seen as increasingly a challenge. And it's precisely the lack of flexibility from the Chinese government and the way that information in China will manifest itself that makes it such a dangerous risk.
Now, the threat of more unrest in the Middle East is on your list as number 3. You call it an Arab summer, or the risk of an Arab summer. How would more unrest in the Arab world hit the global economy?
Yeah, well, this is clearly not a surprising risk. I think everyone understands that the Middle East is a problem. We're seeing much more sectarianism, much more political radicalism. You've got over 60,000 dead in Syria, and that war is metastasizing across its borders into Jordan, into Iraq, into Lebanon, of course, and even into Turkey. The impact is going to make these countries much less investable. It's going to cause an enormous amount of humanitarian trauma. But from an energy perspective, a global energy perspective, actually, these risks, even the Iran risk, not likely to play out into much higher oil prices, because the more important development globally is what's happening in the Western Hemisphere. In my part of the world, unconventional oil and gas, Canadian oil sands, offshore Brazil and Mexico. So frankly, usually when you talk about the Middle East exploding, someone like me, a political scientist, would say, watch out for oil prices. This year, that's not quite the case.
Now, you say that there is a risk that perhaps we've been playing up the political risks over on Capitol Hill in Washington, D.C., as we've seen the argument, or we saw at the end of 2012, the argument over the so-called fiscal cliff. Still, though, you say that squabbling in Washington could pose a risk in 2013. That's number 4 on your list. How bad do you think it can get?
Well, the risk is not the U.S. The risk is Washington politics. No one spending any time near Capitol Hill can think that we have anything close to functionality in the U.S. government right now. And the debt limit issue, the sequestration issue, is going to be much more fraught and much more problematic in its implications than the fiscal cliff that was finally averted. Having said that, all of those risks come against the backdrop of U.S. housing picking up, unemployment from a high level starting to come down, and meaningfully, American corporate profits doing very well indeed, and American growth numbers looking good, not to mention this energy boom I just talked about. So, I mean, there is a U.S. risk, but the risk is that what would otherwise be a quite strong growth environment is probably going to slow somewhat. The risks that you're facing in the U.S. and in Europe and Japan are real, but they're much more bounded on the downside than they are in many of the world's emerging markets. And that's really the point. You know, for 20, 30 years, we've been living in a world where the big engines for growth have been the developed world, and we've been doing the driving. As we move to a world where the emerging markets are doing much more of that driving, and where China becomes the world's largest economy, a poor country, much more unstable, an authoritarian country with state capitalism, the quality of global economic growth goes down dramatically. The risk environment goes up. And that's something that we've not paid attention to for 4 years of financial crisis. But now that in 2013 we're finally putting the financial crisis behind us, we're going to realize that this new normal is much riskier than the old normal.
Now, you made your point when it comes to emerging markets. You're saying that perhaps the squabbling that we have seen over in the United States isn't that big of a risk that we saw it as at the end of 2012. You're also saying that the risks that we're seeing in the Eurozone, perhaps they have receded as well. Do you think then that 2013 will be the year when the perception that Western economies and Western countries are declining, that perception will be reversed?
No, and I won't, in part because the headlines in the United States will continue to show so much incredible dysfunction, even though the markets are starting to price it in and are becoming less spooked by what happens in the U.S. And hopefully the ratings agencies will too, because otherwise they're going to embarrass themselves. They've already done it once with the downgrade the markets didn't care about. In Europe, the fact that there won't be quite as much market pressure as people don't believe the Eurozone will implode will ironically probably take some of the pressure off of the Germans to move as quickly on banking union and fiscal union. So progress may slow somewhat, especially with German elections coming up this year. So 2013 is not the end of dysfunctionality in the U.S. Government. It's certainly not the end of the Eurozone crisis, but I think it is the end of people perceiving that these places are poised on the precipice.
Now, we don't have a lot of time left, but I just want to throw in this question towards the end. Overall, do you think that the risk levels in 2013 are higher or lower than they were in 2012?
I think the actual risk levels are higher, but I think the perception of risk may well go down a bit precisely because people in 2012 were thinking that things were going to go boom, whether it was the fiscal cliff or the Eurozone, Greek exit and the like, that really had no chance of doing so. Funny for me as a political scientist to say that, but in 2012 we were really over-egged. In 2013, we're probably swinging in the other direction.
All right, too relaxed perhaps. Thanks very much indeed, Ian Bremmer, joining us there from New York City. And with that, we're going to wrap up this business interview. Thanks for watching France 24.